All right, today we're diving into Sri Rayalaseema High Strength Hypo, or SRHHL. It's a chemical company with a financial story that, well, it just doesn't add up at first glance. It's a story packed with contradictions, and that's exactly where things get really interesting. And this right here is the central puzzle we're going to try and solve. It's the kind of question that makes you stop and reread the numbers. How on earth does a business see its sales get chopped nearly in half, but somehow become more profitable? I mean, it goes against everything you think you know about business, right? So let's unpack this. Okay, let's kick things off with section 1, a confusing contradiction. We're going to start with the data that seems to have the market totally confused. I mean, just look at the scale of this drop. The company's revenue peaked back in 2023 at over 1,600 crores. Fast forward just 2 years, and it's down to 677 crores. That is a staggering 47% fall. For most companies, a chart like this would be a 5-alarm fire. But then you see this. At the exact same time revenue was falling off a cliff, the company's net profit margin, that's the actual percentage of profit it makes on every single rupee of sales, was soaring. It went from a solid 9.35% at its peak revenue to a very, very healthy 14.52%. So the key thing to get here is, yeah, they were making less money overall, but they were keeping a much bigger piece of it as pure profit. How in the world is that even possible? Okay, section 2. So how did they pull this off? Well, the answer is this kind of classic case of addition by subtraction. And here's the secret, really. The key isn't some disaster in what they were selling. It's about a very deliberate decision on what they stopped selling. And boom, here it is. This is the aha moment. Just look at this table breaking down where their money comes from. In 2024, the trading segment, which was mostly them trading coal, brought in over 182 crore rupees. The next year, it dropped to less than 9 crore. They basically just shut it down. But meanwhile, their main chemical business, yeah, it took a bit of a dip, but it was still the core of the company. So that massive revenue drop we saw earlier, almost all of it came from them ditching a business that moved a lot of product but made almost no money. So this move has a name. It's a strategic pivot. The best way to think about it is like a gardener, right? You see a big leafy branch that looks impressive but isn't actually growing any fruit. So what do? You prune it. You cut it off. The tree might look smaller for a bit, but now all that energy can go to the healthy branches that are actually productive. That's exactly what SRHL did. They cut off the low-profit coal trading to double down on their high-profit chemical business. All right, section 3, the fortress balance sheet. Now that we've cracked the revenue code, let's look at what's left. And let me tell you, what remains is built on an unbelievably strong financial foundation. So what are you looking at right now? What does this number mean? That is the company's total debt. Zero. Zilch. Nada. For all intents and purposes, this is a completely debt-free company. Think about that. In a world where interest rates are a huge deal, that's a massive, massive advantage. And just to put that zero debt into perspective, their debt-to-equity ratio is a minuscule 0.01. I mean, you just don't see that in a heavy industry like chemicals. It means they're not answering to banks, and they have all the freedom in the world to handle a downturn or fund their own growth without taking on a ton of risk. And it gets better. Not only are they debt-free, but they're building up this huge war chest of cash. Look at this. Their cash and investments have just exploded, going from 50 crores back in 2021 to over 366 crores. That's not just good management, that's incredibly smart, turning profits into a rock-solid financial shield. Okay, on to section 4, a unique chemical moat. So, what is this core business they decided to focus on? This is where we find the company's real secret sauce, its competitive moat. Their main product is something called calcium hypochlorite. And look, it's not some weird exotic chemical you've never heard of. This stuff is essential. It's what's used to disinfect our drinking water, for sanitation, for bleaching, and big industries like textiles. We're talking about a product that's tied to things the world absolutely needs. And here's the kicker. This is the crucial point. According to the analysis, SRHL is the only company in all of India that makes the high-strength version of this chemical. This isn't just a small edge. It's basically a technological monopoly in its home market. That is a serious moat. And they're not just big in India. A huge slice of their business, we're talking 40 to 45%, comes from exports. So this makes them not just a domestic powerhouse, but a real player on the global stage, winning business in markets all over the world. All right, section 5. Let's pull all these threads together. So, deep value or deep trouble. We've got a debt-free company with a monopoly-like product and healthier profits, but the market seems obsessed with that falling revenue number. So, is this stock a hidden gem, or is there something we're missing? This comparison chart really tells the story. You look at SRHL, it's trading at a price-to-earnings ratio of just 9.4. Its competitors, way, way higher. But here's the really wild part. Its price-to-book ratio is 0.8. Now, what does that mean? It means the market is valuing the entire company at less than the value of its assets on paper. In theory, you could buy the whole company for less than it's worth. And this quote from the equity research report just nails the whole deep value idea. The market has overreacted to the revenue contraction while failing to reward the improved margin profile and asset strength. I mean, it's pretty clear, right? The argument is that the market is making a classic mistake, judging a book by its cover. But of course, it's not all sunshine and roses. The analysis is very clear about the risks. The company relies really heavily on just one main business. Its costs can swing with raw material prices, and this is a big one. Big institutional investors, the smart money, they own almost none of it, less than 0.2%. For a lot of people, that's a major red flag. So let's just quickly recap the core argument from the source material. Step 1, the market sees a 47% revenue drop and freaks out, completely missing the smart strategic reason for it. Step 2, but if you look under the hood, you find a fortress, a debt-free company swimming in cash. And step 3, because of that initial misunderstanding, the stock is basically on sale, priced at a discount to its own assets. And that leaves us with the big question at the end of the day. Is this one of those classic hidden gems that the market has totally overlooked, a chance to buy a great business for cheap? Or is the market actually right to be cautious? Does it see risks that justify that low price? That right there is the billion-rupee question.